to a very special episode of T-Minus Retirement. I'm Jay Cole.
And I'm Dustin Watts.
And I'm Brian Owen.
And as the year comes to a close here in December, we thought it'd be best just to get together and essentially recap the year in full. And so I'm going to be moderating some questions for these guys, and let's get started.
Yeah. Look forward to it.
Okay. So, what were the most pivotal market events of 2025, and how did they ripple from Wall Street to Main Street retirement portfolios?
Well, I don't think you can talk about 2025 without bringing up the whole tariff episode. It's now being coined the tariff tantrum. Obviously, tariffs were rolled out, broad sweeping tariffs were rolled out in April. And immediately that had a huge effect on the market, right? Everybody was instantly playing economist and, kind of looking towards what would the tariffs would take place, how that would ripple through the economy, and instantly saying recessions on our heels.
Yeah.
And I think that was, looking back, we have we have hindsight, right? That caused a lot of disruption, a lot of panic, and ultimately, as that tariff situation kind of played out, and either tariffs were taken off or put on, or it's kind of hard to track everything that really took place.
Yeah.
We have hindsight to look back on now and say, okay, they didn't really have the effect everybody, and certainly the news, were saying that they would. The market had a quick correction. Pretty much a month later, we were back to business, and now we're in December, and it's turned out to be a really good year. But from a retirement portfolio, from just client point of view, it caused a lot of panic, and it caused some people, luckily not our clients, but it caused some people certainly to kind of make rash decisions and get off sides, and they've been playing a lot of catch up the rest of the year.
Well, if you think about it, when the tariffs were initially announced, some of them were just drastic. And I honestly think that was trying to scare these countries into negotiating, and a lot of them did negotiate much smaller tariffs, or just they brought some things to the playing field and worked out in our favor. But yeah, initially they were pretty drastic. Everybody was kind of scratching their heads on where do these percentages come from?
Yeah.
Why these countries? And I can't say that there was a ton of rhyme or reason, but I guess it didn't, thankfully, have the effect that the doom and gloom, side of the media said it was going to.
Yeah. No, the tariff talk was definitely a big one this year. And another one with that was the continual kind of climb or rise of the tech sector in investing. I mean, it seems to be in America, we love our tech. And, I don't want to speak amiss and say like it was almost defensive, but I think there was so much that just flooded it that at times it seemed like, okay, that's where investment money is going to go. But, we saw that continue to rise in this year in 2025 as a theme.
Yeah.
I would say really, the biggest thing with AI is you've had all these different large language models come out, and of course, NVIDIA has supported that, and there's just all this spending. And like any new technology, there's a ton of hype when it comes out and how it's just going to change the world. And I think we all know AI, we use it probably every day, I would say, in some capacity. Whether it's looking up a quick answer to help you find something. I mean, the way we Google things has changed, really.
Yeah, you get the AI answers now.
Yeah, I mean, nobody wants to search through a bunch of Google pages for an answer.
No.
So it's definitely had a massive effect, and it will change the way we all interact with technology. But on the flip side of that, when there's a new technology, everybody goes to, we're not going to be doing anything anymore. It's like it's going to wipe out every job, and we're all just going to be kind of lemmings and let AI do everything for us. And I don't think that's quite the case, but you've heard that narrative too this year. So we'll ultimately, we'll find out, but it's probably somewhere in the middle.
Yeah, exactly.
Well, kind of sticking with the tariff talk.
Yeah.
So early 2025 saw U.S. markets hit all-time highs. And this was on pro-growth policy hopes. Trump just got elected. He's talking about reducing regulations on a lot of fronts. But eventually tariffs sparked a spring volatility spike, just like as we talked about. How did this little downfall compare to past crises like 2008 or even like 2020? And what lessons should retirees or our clients draw for risk management?
Well, to the ones you mentioned there, in the past 2008, 2020, I mean, they're all different. Certainly 2008 was its own beast, and that was a legitimate crisis when you had just so much systemic issues through the financial system collapsing. And then, of course, 2020, that was kind of a
once in a generation
hopefully
thing,
right? And it was a forced shutdown, and it was a lot of things, a lot of liquidity was then thrown into the market, and of course we got this crazy inflation from it. And then again, the tariff, you could say it's more self-induced, right? But I think the way that it really differentiates itself is the speed at which we priced in, recession basically, with the market just tanking 20%. And then a month later, it's like we just had this complete V reaction, and I just, that's becoming a little bit more, I don't want to say it's common, but markets are moving faster these days. And if there's any lesson to be learned there, it's that when markets are moving this fast and when there's this much speculation, or when there's this much kind of panic, it's best not to make a rash decision and change everything, because look at how, if you would have made a change, look how quickly the market came back, and then literally you've been chasing the rest of the year. And unfortunately, luckily not our clients, but I'm sure that there are people who got out of the market in April and have never gotten back in. And those are types of returns that are very difficult to overcome if you do that.
Yeah, it's hard to cash out when it's low, and then when do you decide to go back in? Because it could increase within the next month, like what had happened, and you get in. If there's a little bit of a blip again, sometimes people get freaked out and just cash out again.
Yeah.
And just say, look, I don't want to be in the market, and they eventually missed out on the rest of the year.
Yeah.
Well, and we've had these conversations in T-minus retirement episodes prior, but it's really, you can't let your political feelings influence your portfolio at the end of the day. And unfortunately, we live in a very polarizing political climate right now. And I know that a lot of actions that were taken in April, there was a lot of political influence, and that really never works out. Don't live your life based upon politicians' actions, because you'll never come out on the right side of that.
No.
Politically polarizing, not us. No, it's appropriate, like what you're talking about, because whether it's mere opinion or it's a bias that sits in us from experience past, where it's the financial crisis, and that recession took longer to climb out of, and then when COVID happened, there was, I'm sure, some of us who thought that this might take a little while, but obviously that was a quick buildup, and then even quicker, which doesn't even compare, is the tariff spike.
Well, and you just never, it's hard to know how the whole situation is going to pan out, because I was in the camp during COVID that it would take a lot longer to come back from a market perspective, a lot longer to come back from that. But I didn't anticipate, and there's no way that I could have known the amount of fiscal liquidity that was pumped into the economy because of that. Those programs didn't exist. They were created out of COVID. And there's no way to know that that's going to take place. There's no way that you could know that they're going to be sending checks to everybody who had to stay home, or to every business who asked for it. There's ramifications for that, and we're still feeling some of that today. But you can't play out every scenario, and even if you do play out every scenario, it's probably not going to go exactly how you think.
It's kind of tweaking on that a little bit. So with a lot of people experiencing, let's call it whiplash, market whiplash, just the lows and the highs, and happened throughout the year just with various other things. What were some perspectives that helped calm maybe conversations you might have had with clients when they were a little bit panicked?
Well, I always like to take a step back. And first of all, as you mentioned, we came into the beginning of this year, I mean, we're at highs. The last few years, really since 2022, we had a bear market. 2023, 2024, we had great returns in the market. So I like to, okay, where are we coming from? We're coming from a high level. Yes, the market pulls back. And then what can we do about that at that time? A lot of conversations with clients about, okay, maybe we have cash on the sidelines, maybe, we need to do some rebalancing, but these are opportunities to put cash to work. And I had a lot of clients, take me up on that opportunity and say, okay, we don't think that this is going to be a multi-year drawdown because of tariffs. We viewed it as more of a short-term negotiating ploy. And it makes you feel a little bit better when we're in that time to say, hey, I just got a 20% discount on buying some good quality stocks. And clients who did that, we don't know the future, but we're now, 9 months removed from that, and I think they're happy that they did it.
Well, markets too were at all-time highs, and usually it's good to get some type of pullback just to have a little bit of ease, brakes on it.
And we've had a couple of those this year, which I think is very healthy. And I try to remind clients, every time the market comes down 5%, there's some worry, like, is this the beginning of some further decline? And, of course, every decline, starts with a 5% decline, every larger decline. But you don't want a market that just never goes down. I mean, ultimately, that's going to lead to worse things. It's very healthy to have markets have these corrections. We had a really great correction. We had a really healthy correction, just in the last month. And we saw the market pull back. We saw rotation within the market. So money maybe coming out of tech, going into healthcare and some of the other areas, industrials, some other areas of the market that, haven't been as loved this year. And that's really healthy because you have money coming out of one area going into another, and it kind of just resets the deck, lets everything settle down. And that is healthy for a long-term, bull market. That's what we want.
Commodities go up a little bit if you have another sector going down. We talk about the benefits of having a diversified approach to investing, and I know it sounds elementary, but when what you're talking about, where essentially rebalance or rotation is taking place, that's part of the benefit of being diversified. So that when there is pullback, we're not necessarily saying everything in every sector pulled back, but you had some sectors that did, others that fared from that, and it's just part of how it all works.
Now, you feel the benefits of diversification when we have these corrections and when we have some of this rotation. Everybody wants to be all in on AI or what have you when it's all going up, but then you got to remember there's a flip side to that. So
What would you say was the impact of the Federal Reserve starting to lower interest rates?
Well, of course, in 2022, we had a bear market because the Fed had to raise rates at the quickest pace we've ever seen because, kind of tying it all together, because in 2020, we just sent money to everybody, and that was obviously a unique situation that caused 9-10% inflation, higher in other parts. But so we're finally to a point where the Fed raised rates, inflation has come down, and they've been able to lower rates. And my personal opinion is I don't think they've lowered rates quick enough, because you do have certain areas of the market stalling out, like housing and things. I mean, that's a whole nother conversation. But lower rates in general, and let's just say normalized rates, right? Because I think we all know that 0% interest rates, like we were in pretty much since '08, that's not normal. And then also these really high rates is not normal either. So we got to have some type of equilibrium, but I think that's really healthy for it to get to a normal area for some of the other areas of the market that, you know, need a little bit more normal rates. Smaller companies, mid-sized companies, you know, they don't have the same access. They don't have cash like a Apple or a Google, right? So they're financing things, and again, they're financing things at a higher cost, which makes it harder for them to do business. If you think of small businesses that aren't even publicly traded, you know, they're having to borrow, or they're, you know, maybe using some credit cards, and those rates are really high. So if all of that can come down a little bit, it just makes servicing all that easier. It just takes a little bit of pressure off of the important segment of the economy.
Yeah.
Yeah. What would you say was some of the smartest moves you saw clients make this year that they were very happy about, you know, here in December?
Well, I mentioned one of them, adding to their portfolios when the market's down. Everybody, it's kind of funny, when the market's at an all-time high, everybody goes, oh, well, if I only had a chance, I would have put way more into the market. I would have, I would have loaded up. But then when the time comes, not everybody wants to do that.
Yeah.
You know, so when the market was down, if you can add to that at that time, I know not everybody's in that position, but if you are, those are the times to do it. Look at that as an opportunity, because we're not that far away from April, and the people who did add are very happy that they did so. You know, one other thing too, I think people are happy that they did, you know, now we're at the end of the year, is there was some tax code changes, and I think that people have been able to benefit from a little bit lower taxes, and they've been able to use that lower rate that they might be in now, or use those changes to their advantage. And we've talked about a whole host of ways to do that, you know, so I won't bore you with it, but people who are saying, hey, I have an opportunity where the next couple of years I'm going to be in a lower tax bracket, you know, taxes just changed a little bit, senior deduction, things like that, and they're using that to their advantage, and I think they're happy at the end of the year that they did that.
Yeah, I think clients that are proactive into finding out ways that they could either save on taxes, or what can they do to help with their investments, the fact that they're just being proactive and, you know, reaching out even to us, it's a good thing, because you never know, especially when it comes to tax stuff, because taxes are always changing, tax code and law is always changing, and it could be something that's new, like the senior deduction, that could really play to your advantage.
Yeah.
Yeah. That was a big part of the conversation this year, and you know, I don't mean to divert from the question you pointed, but it's like, you know, the One Big Beautiful Bill Act, you know, that was another, you know, the theme that kind of went with that was the tax savings. You know, how is that going to benefit us? And you know, senior deduction, that's one thing to consider. And obviously, we know clients have come to us with other questions about, you know, whether it's salt cap deduction, or whether it's some you know, very hot topic, or something else, some other benefit or credit. And you know, we like it when clients talk with us about that, because those are the types of questions where, you know, hey, this actually can work to your advantage if used properly. And so that helping people be aware of those things, helping them, you know, understand how that plays into their whole financial picture, you know, those are the important things to talk about.
Well, and to be fair, when we identify those opportunities, we bring it up, you know, to clients too. And it's working with advisors who are looking at those things. You know, of course, there's clients that are going to call and ask the questions, and that's fantastic, and we welcome that. But I would say more often than not, we're reaching out saying, hey, you have a gap in income. Let's do some Roth conversions. Let's maybe we need to prepay something to get, you know, more of an itemized deduction, or hey, you know, you're going to get a much bigger salt cap deduction. Like, what can we do here? So it's just working with advisors who are knowledgeable about it and you know, going to be proactive. Ultimately, I think it's a big benefit.
So every year, there's always some type of theme when it comes to the market. Some examples would be Bitcoin or meme stocks like GameStop, for example. What would you say was the dominant theme for this year in the market?
I mean, I think it's AI. Of course, it's kind of beating a dead horse, but you can't turn on any financial news or read any article about the market without AI being in the conversation. I mean, even companies that you don't think about that are AI companies, industrials and healthcare and financials, on their conference calls, they're mentioning how they're implementing AI, and that's helping drive their margins. And so I would say that's the biggest theme. I think there's some misconception, and maybe we can talk about that, but I'd say that's probably the biggest theme.
Okay.
Brian? That, and obviously we saw the climb of Bitcoin as well for a time before it dropped. That was for a little bit, that was a theme too. But yeah, I would agree. AI is, it seems like just like, and I have to be careful because we don't want to necessarily equate this AI excitement with, the bubble that occurred in 99 through 01. It seems as though every company is developing, in a sense, the use of AI or we happen to be somewhat, we're a little more invested in our efforts and our R&D into AI as well and how it's going to benefit us. So that definitely has been a theme, just like everybody wanted to kind of be a .com, but again, not to equate that was a different circumstance altogether. But yeah, artificial intelligence is definitely here to stay and not go away.
But it's to that point, it's much more real than 1999 was. I was just reading today, the Hartford Insurance, I don't know, 120 plus year old company. Insurance, I don't know if there's any more of a boring industry than insurance, but they spend the most of any.
So what would you say is or was the biggest surprise of the year when it comes to the market?
Well, I think to this day there's this misconception that AI is the only element that's been driving returns in 2025. There are certain times where maybe that was the case, but we're in December now and we have a whole year of data to look back on, and it's not just AI. And the easiest way to tell that it's not just AI, you can look at the equal weight S&P 500 and it's at all-time highs. So that's not overweighted to technology. It weights everything equally. You can look at small and mid caps. Today, they're at all-time highs. Value names, all-time highs. That hasn't happened in quite a while. All of that is very encouraging. We have commodities that have had a great year, up something like 17-18%. Gold, that's probably one of the biggest surprises. While I did think gold would have a positive year, not because of inflation fears or anything, but for other reasons. But gold is up like 63% on the year. So when you kind of back to an earlier point you made, Brian, it's when you have a diversified portfolio in a year like this, you're getting some love in every part of your portfolio. And that is awesome, because I've had so many conversations with people and they want to argue that it's only AI driving everything. And I have to go through and say, no, that's just not the case. That's why we invest in the markets, and that's why we have things spread out, because times like this, they're getting, other parts of the market are doing very well. We have financials at all-time highs. That's very positive. You can't have a bull market without financials doing well. So I just think that is something that is just totally not on I'll just say Main Street's radar. So that's very positive.
Dare we say even international had a bump this year?
We focus a lot on U.S. markets because we're U.S. investors, we're dollar investors, but international has done very well, and that is something that hasn't happened in a long time. And that's there's currency things going on there as well, but it's great to have parts of your portfolio that's not too much of a sore eye.
Yeah.
You know, you're getting a little love everywhere. So
It's not just tech sector or
because how much tech can you have? I mean, it's the biggest weighting in the S&P. I mean, we all have growth parts of our portfolio. We can't have 100% growth tech portfolio. I mean, you'll love it some years, and some years you'll really hate it.
pulling your hair out.
So.
Well, finally, just to kind of wrap up this conversation, what is the general outlook for 2026?
Oh, that's a tough one. I think there's a lot of positives going into next year. So a couple things. It's the second year of a presidential cycle, right? And those generally are a little bit tougher years. But I think there's still a lot of tailwinds. I mean, we have record cash. It's like over $7 trillion of cash in money market accounts. And money market rates are continuing to come down. So that cash is ultimately, not all of it, but some of it will be deployed to markets. I think we're going to continue to see this efficiency through the use of AI and other things that, hopefully will continue to drive earnings in companies. I think, of course, we have deregulation taking place, a little bit lower rates. What I'm really hoping for in 2026 is that continued rotation into other parts of the market, like, small and mid cap type of names that, will get a little bit of love from some easier, lower rates. I hope the housing sector can kind of finally get the 30-year mortgage down to a place where it becomes a little bit more affordable. I'm sure in 2026 there will be something that the market has a panic over. What that is, that's kind of the
magic 8-ball question.
Right, that's the crystal ball. Nobody knows until it's here, and then everyone wants to say, "Oh, well, we should have known." I mean, it'll be something, but I do think there are a lot of positives as we head into into 2026.
It's funny you mentioned homes or real estate, because I'm sure the majority of purchasers out there or new purchasers would prefer a lower 30-year rate as opposed to the new 50-year option.
That came as a surprise.
Well, I think obviously there's not many people who are going to keep a mortgage for 50 years, but if you did, that's not a good deal.
No.
Yeah, I think one thing for me looking forward to next year is seeing the one big beautiful bill being implemented. Especially when I'm starting to prepare people's returns, and some of the stuff took place for 2025.
Right.
So we'll get to see that when
you're going to get to see the fruit.
The fruit of that, the increased salt. Essentially, no tax on certain overtime or certain tips. And so definitely looking forward just to seeing more people save.
Absolutely.
Instead of giving it to the federal government.
And it's ironically, we've seen in the news recently, locally, I know the Wall Street Journal and a couple other publications have printed some articles recently, but even the younger generations are getting more into saving and investing. And like what you're talking about, as the tax savings get implemented next year under the new act, I think the knowledge as it gets out there and it's shared amongst others, including all generations, but it's really neat to see the younger generation getting into this. And so we're gonna continue to see that, I think, into 2026, where it's like, hey, it's much lower barrier of entry into the markets. I'm going to get involved. Even if I just got $1,000 to go in and get started, we're going to start to see more activity, more involvement.
Well, it's never been easier to get started.
That's true.
So that's a good thing.
Cool.
Well, thank you guys for answering and just for being a part of this. Want to thank you all for being along for the ride. This is actually, we're almost a little over a year into this YouTube channel, and we've had a lot of fun making all these videos. So we thank you for your views. For just those of you who have subscribed, thank you. There's going to be plenty more videos in 2026, so stay tuned for that. But just want to wish you a wonderful Christmas season, a wonderful New Year's, and just a great holiday season. Take care.
Thank you.
Thank you.